you're losing. You're falling further and further behind inflation. So over time, the wealth gap grows, the income gap grows, and this ultimately is very destabilizing. This is how governments get overturned through armed and violent revolution when people can't afford to feed themselves. Hello, everyone. This is Mike Wilkerson. I'm the founder of Stormwall Advisors, the host of Stormwall.com, and the author of Why America Matters. This is the Stormwall Advisors monthly update for the month of August 2024. I want to talk today about the state of the U.S. economy, in particular the consumer, and specifically within that, the impact that the consumer malaise is having on retailers. So before we get started, don't forget to give this a share, a like, a subscribe. Check out stormwall.com where you can find all of my videos, all of my articles, and subscribe there by email to get a weekly update on current events and things that are going on. Let's go ahead and jump into it. As per usual, I want to share my screen here and go through some materials with you, lots of data, and really want to focus in particular on the retail environment, which is, as we're about to go through, pretty challenging. So we've been talking for a number of months now about the state of the U.S. consumer and how the consumer is really struggling with debt, with savings being low, being depleted, with wages not keeping up with inflation, et cetera. Well, all of that malaise is now starting to spread to the retailers. We had some, at least superficially, good news this quarter in that it looks like GDP was up to 2.8%. For the second quarter compared with 1.3% in the first, so at least positive direction there. And similarly with inflation, CPI coming down, headline inflation for June at 3%, core down to 3.3%. Not bad, but it really isn't telling the true story. What is retailer performance, and it's not good. What I'm showing here is a little bit of a busy page, but this is the retailer comparable store sales quarter on quarter. So retailers always track for any given store and then system-wide for a month or a quarter how their stores are doing in terms of nominal sales dollars compared with the year before. And you add this up and you look across quarters and you can see how performance is going. Now, keep in mind that we're in an environment where nominal prices have been going up due to inflation. So when you see these numbers going down, it's distressing on a number of levels. One, it says that consumers aren't in the stores, and two, they're not spending, they're not buying. So we see here that this isn't a recent change, that for a lot of these retailers, especially the home goods retailers, the DIY companies like Home Depot, Lowe's, consumer electronics, even sort of general merchandise goods like Target, quarter after quarter, negative comparable store sales where they're actually going down, down, down. Some improvement in the last quarter or two, but it's been pretty rough. The only exception has been Dollar General, the dollar store company who abandoned it nothing more than $1 quite a while ago. And then Walmart, but even for Walmart, they've seen their comparable store sales cut in half from over 7% to under 4% in the most recent quarter. It's been very challenging. And with that, has come profit margin compression. So retailers have faced both rising costs from inflation, but also been forced to provide higher discounts, bigger discounts, better offers to the consumer in order to try to induce them to continue to shop and to continue to buy. Well, this isn't working for nearly any of them. Best Buy, Walmart managed to eke out a little bit of a year-over-year improvement in their operating profit margin. Everyone else, though, negative. And some, including Lowe's and Home Depot, as mentioned, Dollar General, McDonald's down 2.5% on operating margin. That's pretty tough in an environment where historically, for the last, well, really for a decade now, these retailers have been able to drive operating improvements, efficiencies, and otherwise. All that seems to be changing now. Now, it's pretty severe when you see that we actually have had a couple of big chains declare bankruptcy. In the case of Conn's Home Plus, 134-year-old home goods company, liquidating, selling or closing more than 70 stores. Big Lots, while they're not in bankruptcy formally, they're at risk of it if they can't raise more capital. They've announced a plan to do so, to raise emergency capital to try to stem liquidity, but have also announced that they're closing 150 now unprofitable stores. It's not just the home goods companies or the discounters. It is the global iconic brands like Starbucks also feeling the pain of sales decline for 2 quarters in a row. Orders are down 6%. So that's just pure transactions, consumer transactions. Revenue and profit down 7.5%. And their shares are down 25% over the last year. They've had activist shareholders come in to try to shake things up. They've brought in a new CEO to focus on the turnaround, and he describes the environment as the consumer environment as complex, and that it is, to be sure. Now, not even value mainstay McDonald's is safe in this environment. McDonald's saw their comp store sales decline in the second quarter. The revenues are down, which was the first decline since lockdown, since early 2020. Also have operating profits down. And the CEO's comments were, I think, pretty informative. He was pretty honest. He said the consumers are dropping out of the market, they're eating at home, and they're finding other ways to economize. They're cutting down on trips. In reference to McDonald's new $5 value meal, which they had just put in place, he says it's just not enough to offset the pressure that we're seeing on that low income consumer. Now, going back to the home goods space for a second, just today, as I was going to record, Wayfair CEO announced their earnings. And Niraj Shah mentioned that from his perspective, this situation is similar to the great financial crisis, to 2008, 2009, CFO Kate Gulliver echoing that. And the company noted that the credit card data showing the category is down 25% in nominal terms. If you adjust for inflation, it's actually down 35% transaction volume over the last year. So really disheartening news and showing what's going on. The shares are down 34% to reflect it. But let's just pause for a second and say there's at least one retailer CEO out there who says this is the worst that he's seen since 2008. Now, we talked before about one of the reasons why this is. It's very clear that the U.S. consumer is running out of steam. Households are maxing out on debt. They're depleting savings. Debt's now at an all-time high, coming up on $18 trillion. Credit card debt was up 13% year over year in this most recent report, with delinquency transition rates. In other words, people moving from paying to non-accrual, where they're not paying off their debt, rising across all categories. That's credit cards, auto, student loans, et cetera. And the personal savings rate is now at a low that we haven't seen at 3.4 since right before the global financial crisis. Now, another indication is purchase intent. And so this little survey here, courtesy of Zero Hedge, shows that consumers are putting off big ticket items. So if this tracks from the beginning of 2020, and surveys that are asked, consumers are asked, do you intend to purchase an auto, a home, an appliance this year? And if they answered yes, and this little chart gets tracked. Well, what you see here is since about April, intent is going down across all categories. And in fact, home buying, which peaked at about 7.75% in the summer of 2020, has now dropped in half to just over 4%. This we've talked about before. There's a pretty clear reason for this, which is that housing is now more expensive than ever. If you look back at that time at the COVID lows, 2020, which was, by the way, never really dipped. Prices continued to go up, as you see on the chart, all through the late teens, and there was no real COVID depression in housing prices. In fact, it just kept going up. Well, today, 4 years later, prices on average, national home price index is up 50% against that 2020 level. This is simply pricing most buyers, many buyers, out of the market altogether. They can't afford a home. And at the same time, on the supply side, U.S. housing starts are at a post-COVID low. Since that same time, housing companies are seeing the constraint, seeing the inability to deliver, and worried about the economy and where we're going with recession. So housing is a big issue. But if you look also, another red flag is the number of bankruptcies. So year to date in 2024, bankruptcy filings, federal court bankruptcy filings, are trending well above the last 2 years. And in fact, it's so significant that in each of the last 3 quarters, compared with the 1 year before, bankruptcy filings are up 16% or more year over year. And what's telling within that, this is a combination of both individual and business bankruptcy, but business bankruptcy filings in this quarter, second quarter of 2024, were up over 40% and are now back at COVID levels in 2020, in each case, where we've got just over 22,000 businesses that have filed for bankruptcy in federal courts. So shifting to look at the equity markets and how all this plays out, given the poor retailer operating performance that we've seen, you might assume that the stock price performance of these companies has been equally bad. Well, actually, it's not true. Let's take a look. Sorry, going back here. Is that going to work? Yes. I've described this before, but using something called the Buffett indicator, we can see the relationship between the value of the U.S. stock market, which is this blue line here, and relative in percentage terms against gross domestic product for the U.S. We're now and have been at the highest level of market cap to GDP, well, ever, as it turns out, roughly double, 2 times market cap to GDP, and about 60% above the long-term trend line. So purely statistically speaking, the market is overvalued by any historical standard. So these retailers that we've been talking about with this quite challenging performance, declining revenue, declining same-store sales, declining profitability, declining transactions, surely their share price is reflecting that, right? Well, no, not at all. Retail share price performance has been a bit of a mixed bag. So Walmart up nearly 30%. Now they were the ones that have continued to generate positive comps, even though they've been cut roughly in half. Kroger up 12%, Home Depot, Lowe's up 10 and 5% respectively, notwithstanding the fact that they've had a really challenging environment. Best Buy, even though they've had, I'm not overstating to say it's been a bit of a disaster 2 years, their shares are up 4% over the past 12 months. McDonald's isn't showing here, but it's down roughly 10%. Starbucks, 23%. Dollar General, they have been hit. Dollar General in particular, suffering a nearly 1/3 fall in its share price. But there's something that doesn't match up here between the operating performance that we just walked through and the share price performance, what the market is rewarding them with. And I would argue this is just additional data, additional evidence to say the market has become disconnected from operating reality and trading just on hopium and excess liquidity. Now, we did see in this last month that, hold on, I got to go back here. This is a mind of its own. The Magnificent Seven, this group of the largest big tech companies, names like Amazon and Microsoft and Google, Meta, etc. This has been that group of seven has driven all the performance of the market, of the S&P 500 and of the broader NASDAQ, et cetera, over the last year or two. We've seen in the last month, we're starting to see a pullback as the AI narrative hasn't been burst. It's there, it's real, but it is facing a bit of a reality check on whether all the hype, whether the hype deserves the kind of valuation. So most of the Magnificent Seven, with the exception of Tesla and Apple, are down over the past month, while the S&P kind of was up just slightly. Tech companies generally, as measured by the NASDAQ Top 100 QQQ, down 3%, et cetera. So there is a bit of a pullback there. Having said that, the market remains overvalued. So using this traditional measure, the Shiller price to earnings ratio that goes back to the late 19th century, tracking the relative value of the stock market against the earnings that you were paying for, we are still at a very lofty level of 35.5 times. Now, remember that the all-time high was around 44 times back in 2000 at the peak of the dot-com bubble. And we dipped back down to a more normal level in the mid-20s for most of the period until the post-lockdown, post-COVID period, when the valuation shot way back up again, not quite touching 40, and now sitting at 35 times, almost 36 times, well overvalued. While at the same time, dividend yields, in other words, how much these companies are paying as a percentage of that share price, is at an all-time low of 1.3. Which, when you consider that the 10-year Treasury yield is at 4.1, that you could park your money risk-free and still earn 4, sometimes 5%, depending on the duration and yield, it starts to look like the S&P is overvalued and that people aren't getting what they're paying for here. Now, at the same time, in background, we saw that the national debt once again hit an all-time high. So it's been amusing to watch, and the New York Times has had this on their cover. Last summer it was national debt hits all-time high of 32 trillion, and then sometime in the fall, national debt hits all-time high of 33 trillion. In the spring, national debt hits all-time high of 34 trillion, and then just 2 days ago, same headline, they just replaced the digit. National debt hits all-time high of 35 trillion. So I want to be very clear on this. This is accelerating the pace of indebtedness. The U.S. government is bankrupting itself. The question is how long until the jig is up and creditors stop being willing to fund, and the government is forced to monetize their own debt. For anyone out there listening or watching who is a taxpayer as I am, this debt now is equivalent to $267,404 per taxpayer that effectively we owe on top of all of the taxes that we've actually been paying in order to square this away. I got a kick out of this from the national debt clock. They were the first ones to trigger when the total national debt in real time tripped over 35 trillion. And as soon as they did, they put up this little this little comic here that has Uncle Sam saying, "We need you to keep buying bonds to fund our debt money pyramid scheme." And then, a little mini Captain America on the side showing that the federal interest paid has now gone completely vertical. Just a couple of years ago was at 400 billion a year. That's a billion with a B, and just now approaching $1 trillion a year. It was 945 billion most recently, but clearly going to be above $1 trillion very shortly. And if we couldn't laugh about it, we'd have to cry, because it is actually no laughing matter. It's a real issue. Which brings me to try to wrap this up in a bit of a conclusion. I want to talk about four, well, let's actually call it three, because I don't think one is real. Three ways that this can possibly go. Now, these things aren't mutually exclusive over time, but the three paths are economic stagnation, high inflation, or a bursting of the bubble. Now, the fourth one, which I'll just mention now because I don't want to have to talk about it again, is the so-called Goldilocks scenario, which is what you're going to hear in the mainstream media, the legacy media, that says, "Oh, we're the Fed, the Treasury, everyone's working on a soft landing. Can we just get earnings to start growing again so that we can catch up with this debt, we can catch up with these high multiples, and we can get inflation down under pressure, down back into the 2% range, or 2 to 3%, without stoking more inflation and without destroying the economy." Well, I have said and written that I believe that path is a fairy tale, that it's impossible, it doesn't exist. The idea that a new productivity revolution, which would allow the US to grow out of its debt, it would be a miracle, and it will not happen, because the debt itself is a constraint on growth. It is an anchor on our ability to grow out of the trouble that we're in. Putting aside the regulatory enforcement actions against crypto, against energy companies, all of those things that are working against the natural resources and human capacity inherent in this country, now the debt itself becomes the barrier. So let's go back and talk about these three paths. The first one is economic stagnation, and the best way to think about this is sort of the lost decades for Japan, which we talked about 2 or 3 months ago on the same program. But imagine that systemic over leverage is never dealt with, that you get the slowing growth, either deflation or low inflation, which is good. But on the other hand, you've got all these zombie banks, all these zombie companies, and there can be no productivity. This is terrible in all sorts of ways, but it's especially damaging to younger generations, because the new generation can't find jobs. It results in social breakdown because they can't find jobs. They can't afford to move out of their house and live on their own, let alone get married. And as we've seen in Japan, it will ultimately result in the complete destabilization of society. So that's path number one. Path number two is the high inflation path, which what I've called the deficit debt inflation doom loop, which describes the process of continued government federal deficit spending, trillions of dollars that we don't have, borrowing money in order to fund that, which produces inflation. That debt produces more debt, because the interest rate, as we just talked about, the cost of servicing that debt are now over $1 trillion and continuing to go up. And it creates the illusion of wealth, because if you own stocks, your 401k appears to be going up, the nominal value of your house appears to be going up, and if you own real assets, you seem to be doing okay. It's the illusion that you're keeping up, even though maybe you're just treading water with inflation. That's better than nothing. But for anyone who has to live off of a paycheck, off of real income earned, as opposed to rentiers earning dividends and interest, you're losing. You're falling further and further behind inflation. So over time, the wealth gap grows, the income gap grows, and this ultimately is very destabilizing. This is how governments get overturned, through armed and violent revolution, when people can't afford to feed themselves. The third path is the bursting of the everything bubble, which is that when the markets and the economy sort of suddenly and dramatically crash, which leads to a massive debt restructuring. The difference here is that it's a painful reset, including government spending. So it does get things under control, but no one wishes this kind of pain on anyone. Now, what happened in Japan was a combination. That's why I say these are not mutually exclusive. But in Japan, they went through a process which actually went from this high inflation, really not as much high inflation as just allowing the credit bubble to expand. Eventually, around 1990, that bubble, the everything bubble in Japan, burst. They were no longer able to do what they had been doing. But instead of addressing the problem and allowing banks to fail, allowing firms to fail, they propped them up. And they refused to address the structural issues, the systemic issues that had brought this about. So you can move from one thing to the other, as Japan did, going from a bursting of a bubble to making policy choices that left them in economic stagnation for 3 years. In my view, path number 2 seems the most likely for the US, because numbers 1 and number 3 are just more obviously damaging to institutions. So government is forced to stop spending here in the bursting of this bubble. A real reckoning would require a balanced budget or moving out of this deficit spending for the long time. But path number 2 seems most likely to be attempted because it is the way to defer or kick the can down the road and to preserve, again, even if the illusion, wealth of the financial elites, people who own things, and everyone increasingly grows miserable over time, whereas numbers 1 and 3 are more accelerating a path towards turmoil and revolution. So going to wrap it up there. I hope you've appreciated this and enjoyed it. I know it's not necessarily pleasant news to hear or a topic to discuss. In summary, retail environment, very bad, reflecting a constrained consumer, reflecting an economy that is much worse off than the narrative would allow you to believe. A lot of this has to do with the reality of jobs and employment being much worse than what the data are showing. We don't have time to go into that today. I've touched on it in the past. Maybe we can come back to it. But this is a real problem. So number 1 is the economy's much worse, and we are, in my view, headed now into the recession that was supposed to happen, if you believed everyone last year, is now looking more and more likely that we are actually moving into a real recessionary environment. Number 2, when we see that happening, I think we're going to see reduction in interest rates that will allow the inflationary dragon to get back out of the cage and start rattling around again. So we'll see going back into that inflationary perspective. So consider ways, whether as a business or an individual household, how to protect yourself in that environment. So I'm going to sign off here, leave it at that. Again, don't forget to give this a like, a share, and a subscribe if you're watching this on YouTube or podcast or anywhere else. Helpful to get the word out. Enjoy the rest of your summer, and we'll see you next month here on the Stormwall Advisors Monthly Update.